And good evening. My name is Rob Newman. I am one of the partners of a firm of accountants called Carter, Collins and Meyer. And I was very kindly invited to come and speak with you this evening about starting your own practice. I've got an awful lot of material to cover. When I put the slides together for this, I thought, God, I could do a week's course on this, not an hour. It will be recorded. It's being recorded automatically. It's going to be put up on my YouTube channel, my company's YouTube channel, which is Carter, Collins and Meyer. I will send a link to the two kind people who asked me to speak, which was Debbie and Liz. Slides will be available, and there's a number of things within the slides giving links to downloads and various resources that might be useful for you. Please do ask any questions as we go. I'll try and pick them up occasionally. Happy to do anything at the end as well. I think it could be a bit death by PowerPoint. Without further ado, here we go. He says, hopefully this will work. There we are. So here we go. Slideshow. So you want to start your own business. The format of this is I'm minimized up in the far corner. Thank God you don't get to see me in full view all the way through. And then slides as we are. About me, yes, lots of qualifications, very clever chap and all that stuff. I've also started and sold about a dozen businesses directly. I've been involved with a couple hundred others. I represent as an accountant a couple of thousand. I've seen lots and lots and lots. It's all been at the small business end of things. I've not done stuff at corporate level, other than the stint with government, which was at the beginning of my career. Before starting, I thought this was quite a good one. My mum says that I have to go inside and take a nap. That's the kind of over-regulation that's killing small businesses. It's a difficult thing starting a small practice. It's a difficult thing starting a small business. There's lots and lots and lots and lots to do, which very neatly leads me into a couple of things. One is the health warning. One of the quickest ways to lose money is to actually start a small business. Small businesses are the dream of many, the pain of a lot. Something like 90% of small businesses go bust in 3 years. From my experience, both as an accountant and an insolvency, never held an insolvency license, but as an insolvency practitioner working in insolvency firms, it often isn't the financial of starting the business that actually create the closure of them. It's often the stuff, it's the things around it, the small lifestyle things. Lifestyle of a small business owner is not pleasant. Sorry, I just want to ask one more thing. I've had a thing saying you're not seeing slides. If that's still the case, please do let me know. I think that they should now be being shared, hopefully. Lifestyle of a small business owner is painful. There's a lot to take care of. There's a lot to do. Because there's an awful lot to do, it's sometimes overwhelming. In fact, it's often overwhelming. There's an awful lot to take care of and deal with. What I'm going to cover today is selling, which I think is probably one of the most important things you can do if you own your own business. Organizing yourself, selecting a legal entity for your business, registering with tax authorities, accounting and bookkeeping, value-added tax, income tax and corporation tax, cash forecasting, and getting credit, insurance, and useful contacts. As I say, there's an awful lot to cover on that. So selling is the most powerful thing and most important thing you can do as a small business owner. He who owns the business, or he who owns the sales owns the business, as I've written there, and without sales nothing exists. The selling side of a business I'm not going to talk about massively in this particular presentation. I do have a separate one which is there which I would suggest you go back to. There we go. And I also have a book to download, 57 Steps to Building a Small Business. It's probably the most crucial thing you can actually do as a small business owner. I have got something that the slides aren't changing. They are at my end. Unfortunately, there's not a lot I can therefore do. I'll just keep talking, I'm afraid. The slides will be available for you on download if you want to pick them up. As I say, it's something that's not seeming to be happening with the actual recording process. Apologies for that. Not a lot I can suggest. Anyway, selling. As I say, selling is something that is crucial to your day-to-day operations as a business. It's absolutely vital that to do anything, you are going to have to be selling all the time, everywhere, with everything. You can't keep up with the big boys. You're not going to sorry, I'm going to just try and sort this out because I'm getting an awful lot of feedback on it. Stop the screen share. Hopefully you can see me again. If we start with screen share and is that any better for anybody? Hopefully that has affected things. So just trying to pick up there. You do have to make sure you are selling constantly. The selling process is, okay, it's no better. I will just abandon the slides part completely because it's not going to be able to work for you, for me. Okay. The whole selling process is absolutely critical to what you are doing. If you aren't selling on a day-to-day basis, you are not going to be able to undertake functioning the actual business. I'm completely put off by this now. Forgive me. I'm just going to turn off the chat bit because I'm not getting anywhere with that. If you're unable to actually sell, you're going to be unable to be operating and functioning the business on a day-to-day basis. You've got to constantly be looking for new business. That's going to be a process of, particularly in the beginning, tapping into the networks that you are available, that you know of, that you're available to, that you already know people within. It's going to be a guerrilla sales and guerrilla marketing approach to things. Have to be able to adapt processes that you do have available to you. One of the best things I can suggest is postcards, emails to the people that you already know, postcards within areas that you are in. Literally go door to door and shove them through, visiting cards for areas, hand them out willy-nilly. Business cards are a little bit of a waste of time. They don't communicate an awful lot. Postcard can get an awful lot more to you. But as I say, pick this up more in the 57 Steps book that I prepared, and also at the webinar, which is available via my own YouTube channel. The next thing that you're going to have to actually address is organizing your own time. Organizing your own time is a key thing within self-employment. If you don't stay on top of the demands coming at you, you will quickly start falling apart. The different demands coming at you will be extreme. You have to get the work in the first place, do the work, get paid for the work. It's a three-part process, and it does quickly become overwhelming. At different parts of the business life cycle, you will have to adopt different types of organization. There's a specific webinar that I put together a couple of years ago, I think now. I've got extremely short hair in it, which talks about this in a lot more depth than I can cover today with the limited time I have available. Selecting a legal entity for the business. There are 4 potential legal entities for your business: sole trader, partnership, limited liability partnership, or limited company. They each have advantages and disadvantages. Depends on where you're at with the development of your business. The simplest structure to take, the one that you can get going with almost no documentation and nothing in place, is the sole trader. Sole trader is you as an individual trading in the world. It's very quick. It has the least admin. The admin you do have to do, I'll cover separately to this under the registering with the tax authorities. The disadvantages of a sole trader is that it has no legal separation from you. What that means is if anything does happen or go wrong with it, you are fully liable for anything arising. It's very much identified with you as an individual. It's you being you trading with the world. My own instinct, and from having loads of different businesses, even as a startup, is I wouldn't go down this route despite it being very flexible. However, if you are unfamiliar with business and you want to just keep it simple, that's probably the easiest way to go. If you do have other employment, that again will allow you to use some of the tax advantages of sole traders against your other employment. It's very likely in the early days of operating a business, the first year you will lose money. You've got a lot of setup costs to do. You've got a lot of things to put into it. The second year of operating a business, you are likely to just about break even. And the third year is probably before you're going to make a profit. With the sole trader, there is some tax advantages if you're getting that and you've got other employment. There's just some tax advantages generally in those early stages for it. Partnership is a couple of people coming together and trading as in union with each other. Again, there's good and bad to this. Partnerships have a tendency to go wrong, and the law governing partnerships is very, very old. 1890, the Partnership Act. They go wrong just because people fall out, and the law is very old and it's very loose. It allows disputes to happen quite easly. I think, again, I don't know how likely it is within the particular group I'm talking to for nutrition therapy is for you guys to be forming partnerships at this stage. But if it is considering, I would urge you to get a deed of partnership. Deed of partnership does not have to be a long legal document, although it can be. But it is a list of rules that you have created between yourselves. I think some of the most important things to include in there is the hours that you're going to divert or devote even to the actual business, how many, when you're expected to turn up and leave, when you're expected to, how many holidays you can have, how much money you can draw, all the stuff of good governance. Partnership in many respects is like a marriage. And although I don't have that in my own marriage, we do have sort of established rules, which I would be keen to put in place quite quickly if I was entering into one. An LLP, a limited liability partnership, is a hybrid of a company and a partnership. They came about actually because of accountants. They're probably they are the newest of all of these. They first existed in 2000, actually, the year 2000. They are probably the most administrative complex or complex administratively to be used by you. Limited companies. The key thing of a limited company is its separation from its owners. It is a legal entity. It is a person in its own right. It has a birth certificate called its certificate of incorporation. It has the ability to enter into contracts on its own. It is a standalone thing. It also potentially has lower tax rates depending on what you're doing with it and where you're at. 10 years, 15 years ago, that was a definite. It definitely had lower tax rates. It's not as much of a thing nowadays, particularly at lower levels of earnings and particularly in loss-making situations. Partnerships and sole traders can actually be tax efficient, more efficient, and actually get better results. But it is this separation between you and other things. And I think that's particularly useful if you're giving advice personally. God forbid, you don't want to be giving the wrong advice to people, but in professional services, it does happen. This is why later we talk about insurance and professional negligence insurance, but professional indemnity, I think it's probably is the proper way of saying it. But limited companies also give you an added layer of protection. They allow you to walk away from situations that go wrong. So commercially, they are my preferred route for things, although the admin is a little bit more than a sole trader. The next part of this, depending on which one you've actually picked up, which one you're doing, is registering tax authorities. Each of the different ones has a different lane. I cover the main ones in a second. The registering of the tax authorities, as I say, this could be a whole topic in itself. I start this with a quote that I had on my camera for ages, originally from Viz Comics. I was delighted when the kind people at the Inland Revenue recently wrote to me to tell me my tax return was outstanding, particularly as I can't even remember sending it in. They extended the tax filing deadline this year. That's uncommon. It's the second time in the last 30 years that I can remember they've done that, both to do with coronavirus. Tax compliance is very date driven. It's very set. There's loads to remember and do. It's second nature when you do 2,000 tax returns a year, as I do. It's confusing as mud when table in this, but it's very easy to get wrong. There's tons and tons and tons of rules around this, as I talk about later. There's 6,102 pages of tax law. I'm not covering all of them. You'll be delighted to know. But let's stick with the basics of registering and what you are expected to do. So if you are registering, if you're going to register either as a limited company, sole trader partnership, or limited liability partnership, you are going to have to get, within 3 months of commencing trade, a unique taxpayer reference for the entity trading. It's a UTR. Now, if you are trading as a limited company, you're going to need a UTR for the company and for yourself. If you're trading as a sole trader, partner, or LLP, you will need, well, if you're trading as a sole trader, if you're trading as a partnership or LLP, you will need one for the partnership, for the LLP, and yourself. And if you're trading just as yourself, you need one for you. You will also need to register for national insurance contributions if you are a partnership, limited liability partnership, or sole trader. The simplest way to do this is using Form CWF1. Links are given on there. If you fail to register yourself, your limited company, your partnership, your LLP, within 3 months, fines and penalties do apply. They are reasonably lenient on startups with that. They don't tend to impose it too often, but I have. It can start getting meaty if it's left ridiculously long. If you left it indefinitely, you could be into some serious fines because you then start missing filing deadlines for things as well. You need to register by the 5th of October following the end of the tax year. To send in a tax return. If you're late, you'll get. Tax year runs from the 6th. This is the personal tax year, runs from the 6th of April to the 5th of April on a year-to-year basis. It's at the weird dates because it's to do with the changeover from the Julian into Gregorian calendar, or whichever way around that was, back in 12, whatever that was. And they didn't want to miss any tax revenue whatsoever, so they made it a weird date. The company's tax years run according to the company accounting year, so it's different. The company fiscal year, it runs the 1st of April to the 31st of March. I bet you're already confused. But what this is saying is, if you start in business as a sole trader, You have until the 5th of October following the last 5th of April to register. So 5th of April 23, you've got till the 5th of October 23 to register, etc. As I say, got to register for national insurance contributions as well. That can be done on CWF1. VAT, I'm going to come on to a whole section of VAT because I did a little bit of digging specifically following the Zoom call I had with Debbie about nutrition therapy and its VATable consequences. So I'm going to skip this slide at this point. I am going to talk about making tax digital for VAT. At the moment, anybody that's VAT registered has to make has to be part of making tax digital. This is a process the government has brought in without really thinking it through, of insisting that businesses record their sales and inputs, the sales and purchases digitally as opposed to hard copy. In theory, in reality, it's fudge. You can still do it on an Excel spreadsheet. You can still capture things manually. Again, I'll talk about some of keeping records. But what you do need to be aware of is that it is becoming more of an issue from 24-25. So that's the 6th of April 2023. No, 6th of April 2024. So 2 years. 6th of April 2024. Anybody with £10,000 of earnings other than through PAYE falls into making tax digital. So we'll have to keep electronic tax records from that point onwards. Now, again, typical HMRC, they haven't given any real guidance as to how to do this. They haven't really talked about what's involved. They haven't given any specific links. They've not provided any software, etc., etc. And based on the current rules for MTD for VAT, it will still be incredibly fluffy and vague and flexible. It's something that you are going to have to keep an eye on, though, because £10,000 of income from sources other than PAYE is increasingly not a lot. If you had a buy-to-let property, it could be 1 or 2 properties. You could be up to that already. Even with nutrition therapy, you could rapidly get over £10,000 and suddenly find you've got a whole raft of extra record keeping that you need to do. I do make some recommendations for software later. I don't particularly talk about the practice management software that you guys have been recommended. I have had a look at it. On a skim the surface and read the website, it seems very good, but not using it's not really my area, so I'm staying away from that one. What I have next is a calendar of events for the tax authorities, all the different things that you potentially have to do within a year. So monthly, there's payroll taxes. Quarterly, there's CT61s and VAT. There's RTIs and P11Ds and Class 1 NIC. That's on the screen. There's lots of it. If you do use an accountant, they will remind you of these things. If you don't use an accountant, please do sign up to the reminders on HMRC's website. They are not bad for reminding you of things. They don't automatically remind you of anything anymore. Once upon a time, they did used to send all this stuff out to you. They don't anymore. They've saved millions by not putting it out in hard copy. There's lots and lots of filing deadlines, though, so be aware. Accounts. Listen, it's dead easy for me to get dead excited about this. This is the day job. Accounts and bookkeeping, though, for most people is utterly tediously boring, which is why years ago I came up with the story of 3 boxes. Fundamentally, you now know everything about accountancy. 3 boxes. Everything you sell, everything you buy, and your bank account. Now, if you've got a trade, for each trade that you have, you want a separate bank account. If you're going to use a limited company, it should have its own bank account for each type, and you can mix trades within limited companies. But for the purpose you want a separate bank account. You do not want to run your trade, your nutrition therapy business, through your personal bank account. There's a whole host of reasons why you don't want to do that. One, it makes record keeping or the two biggest ones. One, it makes record keeping damn nearly impossible. And two, if you ever do get an HMRC inquiry and you have a 1 in 9,000 chance that you will, they have the right to look at any record that relates to your trade. What that means is your personal bank statements are now fair game if you are using them to run your trade through, which means every expenditure and income that you have on there is fair game for them to question, write back, criticize, etc. Open a separate bank account. All the banks are crap. All the high street banks are crap. All the online banks are crap. They're all crap. None are better than the other. If you're going limited company, the online banks have a habit of being able to give you bank accounts quicker than the high street banks. If you're going the high street, good luck to you. You're going to take 6 to 12 weeks to get a bank account. But keep all of the bank statements separately. Now, if you want to do this electronically, fine. But the principle is still the same. It is still 3 boxes. One box is your electronic bank statements in PDF. One box is your sales in PDF. One box is your purchases in PDF. Sales are anything that you sell, anything that gives you income, any therapy that you provide, anything that you do for anybody needs to be recorded. You can record that any which way that you so choose, so long as eventually it is captured somewhere. One day when MTD for income tax comes in, or if you have to go straight into the MTD for VAT club, you're going to have to do that electronically, which means either outsourcing it to somebody, keeping an Excel spreadsheet yourself, or using software. But for now, you could literally go down to Staples, buy a £2 invoice book, write out invoices, hand them out to people, and then write it up at the end or present it to an accountant to turn into something. Purchases are anything related to business. What can I claim? That's what I'm always asked. I give you 2 links at the end for this. The rules are vast. There are 6,102 pages of rules. It is wholly and exclusively for the purposes of trade is the overriding rule in relation to what you can claim. If it has a point for business, you can claim it. If it doesn't have a point for business, you can't. If it is mixed use, you may be able to claim it. Eye tests are claimable, glasses are not. Eye tests are claimable because the screens destroy our screen, you wear outside of business, and therefore you can't have them. There are loads and loads and loads of stories around this. There are loads of rules as to what is and what is not. I am not going to bore you to death with them, particularly as I only have an hour. The next part of keeping accounts is a little pictogram. As I say, it's split into 3 things: stuff you sell, stuff you buy, your bank and credit cards. And it goes from the cheapest way of doing it to the most expensive way of doing it. The most expensive way of doing it is to give every single piece of paper in hard copy to an accountant. I'd love you to, because then I can charge you the most, or your local friendly accountant. Right the way through to the cheapest, which is you keep software, analyze everything yourself, reconcile it all, make sure it all ties up to the bank, make sure that everything is scanned and is electronically available. Provided fundamentally you have 3 boxes of things you are covering yourself. The ins and outs of keeping it and what you have to record are beyond the scope of what I can cover today. There are loads of stuff on my channel about this. There's a whole 2-hour video about what you should and shouldn't do. If you do want tutorials, I have a team of people who can happily help with you. And I've got loads of guides that I've written around this as well. A word about accounting systems. They're brilliant, but they're crap. They're all good, they're all bad. It depends what you put into them. If accounting and keeping accounting records is not for you, having a complicated accounting system is not going to help you in any which way. And please do not believe the bullshit that QuickBooks put out, and others, but QuickBooks are particularly bad for this, where you see the plumber walking out the house with his mobile phone, and my books are done just by pressing the button. It's absolute crap. Doesn't work that way at all. There's still loads to do in the background, and there is nothing more frustrating or annoying as an accountant than getting a half-done set of electronic books. I'd rather have 3 shoeboxes. Much quicker and easier to resolve. That said, if you do like doing these things, I wouldn't rush out still and get QuickBooks or Xero or Sage. There's a couple of free ones that I suggest later. Oh yeah, even on the next slide. A couple of free ones, QuickFile and Free Agents. QuickFile is free to everybody up to, I think it's 2,000 transactions a year. Then after that, it's about 30 quid a year. Free Agent, if you bank with half a dozen different banks, they'll give it you for free. I can't remember the banks. It'll be on their website. I think Free Agent itself is actually owned by RBS. So it's probably any of the RBS group banks. There's Sage, QuickBooks, Xero, and a million others. Xero is bleeding expensive. There's a lot of hype around it. It's okay. It does some of its stuff that it's supposed to do, but it's nothing particularly spectacular. Sage is all right. It's designed for even their small version, truthfully, is designed for bigger businesses. One-man bands, it's probably overkill. QuickBooks, I just hate. I just hate it. It's written for Americans. It's done in an American way. Everything about it's American. It's not designed for the English systems, and it just doesn't cope very well. It's awful to follow. There you go. If you do want to use them, fantastic. There is a top version. There is a desktop piece of software that I think is ace. I wish they'd turn it into a cloud piece of software as well. It's called VT Transactions. You won't see it advertised anywhere because it's something like 99 quid once and you never pay ever again for it. But again, you're going to have to get used to how it works. If this isn't something you particularly want to do, just revert to 3 shoeboxes. Will solve most of your problems, believe me. Taxable and VAT for nutrition therapy. Is it vatable? That notice 70157 sets out the VAT treatment, and there's the link to the HMRC website giving this guidance. Highly exciting reading. It's something like 400 pages long. I did actually read it the other day in preparation for this. State registered dietitians are exempt, but nutrition therapy is not included in the exempt list. In other words, what you do is vatable, which is why the next 2 slides apply to you potentially. Value-added tax. VAT is a tax on customer expenditure and ultimately paid for by the final customer. Most business transactions involve the supply of goods, services, and are vatable if they are made in the United Kingdom by a taxable person in the course or furtherance of business and are not specifically zero rated. VAT is collected quarterly. There are 2 types of registration, compulsory and voluntary. Now, my view on this for you guys is you would only be looking at this if it was compulsory. Compulsory kicks in when you turn over £85,000 a year or more. That means you are making sales of 85,000. Now, if you get to that stage, congratulations. Particularly as a sole practitioner, you are doing exceptionally well. I think you are probably at the upper limits of what is going to be achievable on your own. If you go beyond this, you're probably going to have to need staff and organize yourself quite differently. If you stay below £85,000 of turnover, that's sales, you do not need to register for VAT. Because VAT is paid by the end to is irrelevant for businesses. My business doesn't care whether you are VAT registered or not if you are supplying to my business. I personally do care, because either you're going to have to charge me 20% more than you would have done, or you are going to have to earn 20% less than you would have done. When I quote something, I quote a tax return, it is £150 plus VAT. That makes the final price 180 quid. If you are a VAT registered business, you don't care because you get that £30 back. If you are not a VAT registered business, if you are an individual, it now costs you 180 quid. If I want to try and stay competitive dealing to individuals and everybody is only charging 150, I still can only charge 150, which means I'm going to have to pay the £27 of VAT to be due on it, meaning I don't earn 150, I'm actually earning 133, if I've added that up right, or 120, yeah, 123 even. You see the difference in income, significant, if you end up in the VAT club and don't need to be. Now, I would urge you to get into if you don't have to, as I say, but be aware that if your taxable supplies in a 12-month period get near 85k, you have no choice. Again, at that point, go and talk to an accountant. I think it's probably going to be something that you want to consider. A few things at that point. If you started off as a sole trader, you are probably at the stage of wanting to be a limited company. If you get to the £85,000 mark, there is still probably a corporation tax saving to be made at that stage, as opposed to income tax. There's probably a lot of things to change. In other words, if you start edging above 75,000 turnover, you certainly want to start being. If this is going to be a part-time thing for you and you're going to be doing 10 or 15 grand, it's probably not going to be as relevant. What that means is I'm going to skip the voluntary bit. I'm going to try and stay vaguely on time with this. This is to give you an awareness of certain things as opposed to the ins and outs of everything. If you do end up in the VAT club and you do end up having to make returns, you are definitely going to have to use software. And again, this could be a reason why you may wish to go and sign up for the services of someone like myself at that point. Income tax and corporation tax. That's a picture from my office. And that represents about 4 foot, I think it is, 3.5 foot of books, 6,102 pages. And the books are like tissue paper. I'm sitting at home at the moment, so I don't have them available. But the books, it's like tissue paper. Tiny print. I can honestly say I've never read them all the way through. Their reference guide. When I did do my exams, I did have to know my way around it quite a lot, and I probably at that stage I probably knew it more than I do now in terms of the technicalities and section numbers and references and all that kind of stuff. It's vast. Yeah, it's absolutely vast, the rules on this. So what I have, 2 summaries for people to go and have a look at. One for sole trader partnership LLPs, one for limited companies. The sole trader partnership LLP takes you through income tax and will cross over into limited company. If you're a limited company, as I said earlier, you've got to do stuff for the company and stuff for you. If you're a sole trader, it's just stuff for you. If it's a partnership or LLP, it's stuff for the partnership or LLP and you. It's a lot of stuff to do. When MTD for income tax comes in, you are going to have to do, even as a sole trader, you're going to have to do 5 tax returns a year as a minimum. If you were VAT registered, that now becomes 9. If you have a trade and a buy-to-let property, that's going to become 13 tax returns a year to do. All the accountants in the UK are doing this at the moment, going fantastic. Thank you so much, Mr. HMRC. But the amount of compliance on small business is crazy. Yes, that's why software is there. That's why stuff is around, but it's hefty. The main rates to know about are you get a personal allowance. It's currently 12,570 quid. That's the amount you are allowed to earn tax-free. This is as income tax. Forget companies for a minute. 12,570 quid is what you can earn tax-free under income tax. If you are PAYE, that figure may look slightly different because they're going to add on and take off stuff from you if you get benefits in kind, or you are a higher rate taxpayer and chargeable to child benefit, or higher rate taxpayer with a threshold allowance reduction based on earnings. There's a million reasons why, but everybody gets that, and it's adjusted in a tax computation on it. We always do everything from first principles accordingly, so we actually almost ignore tax notification codes other than to give us a heads up if the individual taxpayer has something else going on. The next 37,500 and whatever it is, 30 quid, so up to 50k, is at 20% for income tax. So 12,500 nil, up to 50k, the rest of it up to 50k is at 20%. From there to 125,000, no, 150, sorry. From there to 150,000 is at 40%. From 150,000 over is at 45%. However, at 125, you will have lost your personal allowance completely, which means your effective marginal rate actually becomes a lot more than that. And I think it works out something like 60% because you actually lose your bottom part of it. And then you've got national insurance rates and everything else on top of it, which is why to sit here and try and know this off the top of your head is almost impossible, even for someone like myself. Even then, limited companies is 19% on earnings. Again, that is subject to potential change. There has been stuff that's been announced that if you are a limited company, you pay 19% on the tax. If you then take money out, you have personal tax to pay on it as well. Dividend tax is actually at 7.5% and 32.5% and 38.5%, depending on how much you own. There's another set of tax rates on top of it. Yeah, loads of stuff, loads of things to remember. Don't really bother trying to remember those. Just think about it more in terms of the tax year ends, the filing dates, and the stuff that I put on the previous slide. What you do have to remember is 5th of April, 6th of April, you have a tax return to do. You have to have registered for that by the 5th of October, and it has to be in by the 31st of Jan. If you get that much, that's pretty much most that you're going to get. A couple of things you should know about then, moving in terms of tax, if you are going to do this: taxable benefits, or tax benefits, and taxable benefits. Tax benefits, despite the 6,102 pages of tax law, that is not looking at benefits. It's purely taxation. Tax benefits, you've got working tax credits, child tax credits, both of which are slowly disappearing from the system and being replaced by universal credits. I know almost nothing about these. They're not day-to-day for accountants, universal tax credits. Your best bet is to go to entitled to, I'm not sure if that's .co.uk or .gov.uk, but if you type entitled to into Google, you'll find it. It'll run you through questions and say whether you have any opportunity to get universal credit. Child tax credits, working tax credits used to be an accountant's thing. If you're still knocking around with them, I'll be honest with you, I'll try and stay on them as long as you possibly can. You could do exceptionally well with those at one point. We used to be able to ensure that lots of clients who earned lots of money actually got them. Can't really do it anymore. Something to watch out for is child benefit. If you or a partner earn over £50,000 a year, your child benefit starts disappearing. Again, £50,000 a year is not that difficult to hit, depending where you are in the country. If you have a PAYE job, a couple of buy-to-lets, and now do some nutritional therapy on top of it, you could actually be easily edging that. It's pretty much an all or nothing. If in a household one of you earned 100,000 and the other earned, well, not going to take that number because that'd be awful. Actually, no, you could. If one of you earned 100,000, one of you earned nothing in a household, you would lose all of your child tax benefits. If you both earned 50, in other words, household income is exactly the same, you would still have 100% of your child tax benefits. It's pretty much a cliff edge. It very quickly disappears, so that by the time you reach 60k earnings, you get nothing at all. Again, give thought to this if you are suddenly starting getting extra earnings. 15 minutes to go. I promise I will shut up. It doesn't get any more exciting though, I'm afraid. There's still lots to cover. The cash planning, turnover is vanity, profit is sanity, and cash flow is reality. I think that was my day one in accountancy. Turnover is vanity, profit, sanity, cash flow is reality. Dead easy to be a busy fool. You must price your work properly. Pricing is pretty much a black art. What can you charge people? Well, it depends what everyone else is charging. If you really don't have a market guide for it, you can't see what everyone else is charging. or they're just all idiots and doing it all wrong, which does happen. I have seen that within the accounting world before now. Something to do is to work backwards. How much income do you actually need a year? How many hours can you work? What are your overheads? So let's work forward. A full-time job is 18, I'm doing this on a calculator. Full-time job is 1,800 hours a year. With that, if you are self-employed, you are going to have no more than 70% able to be fee earning, because 30% of your time is going to have to be admin, promoting business, traveling from place to place and doing all the other stuff that you've got to do, which means that gives you something like 1,200 hours a year to actually work. If you want to earn £30,000 a year and you've got overheads in the business, the insurance for light, heat, power, and all the other stuff you've got to pay for the business of another 20,000, you need to get £50,000 of revenue in 1,200 hours, which means your charge out rate has to be £41 an hour. Do you get the idea? In other words, as a sole practitioner, as a sole trader, creating a personal service business, you have to give thought to how many hours you have available, what level of earnings you want, what overheads you have, and divide up one by the other. That's going to allow you to separate the turnover, the profit, and the cash flow. Cash flow is the amount of money that's coming in. In the you really do not want people being paying you on the drip. You don't really want debtors. You want people to be giving you cash on delivery, or even better still, booking you and paying as it goes. Aside from the practice management software that I know you have been other things I would look to is something like Calendly. Alternatives are available, but I personally use Calendly. Calendly also, as well as scheduling and booking your time and letting you have a controlled diary, actually allow you to take payments as bookings are made, which means potential clients you never need to worry them with the "can I have my cash now" bit, because as they book you, they actually pay you. The next slide is useful. It's places to go and lots of things to download. If you're starting in business, I've got a range of calculators as to how much money you actually need to start up in business. It will take you through the thought process of the things you are likely to need to do. I then have a range of cash flow forecasting spreadsheets. They're Google Sheets. They, again, take you through the steps that you're going to have to think of. I hate business plans, but think they are entirely necessary. There's nothing worse than a £5,000 business, a 5,000-page business plan that waffles on endlessly about nothing. You're much better to have a one-page thing. There is a great resource on YouTube, Business Model Canvas. It's a one-page plan. It doesn't need anything fancy. You can do it on a single piece of A4. I would urge you to look at it before you even start. Getting startup loans for a business is very difficult. Your best bet is from the government. You can potentially get up to 25,000 quid to get your business off the ground, repayable over 5 years. There is a personal guarantee. If you do have to give a personal guarantee, go to Google and type personal guarantee insurance. Buy the insurance. It will usually cost you 2% of the transaction value. So if you're borrowing 25,000 quid, it's going to cost you 2% of that, about £500. In the event of something going wrong, it will cover you for up to 80% of the value of it going wrong. Don't give personal guarantees without having insurance. Recipe for disaster, particularly in startup businesses. Potentially there may be some grants available. It's unlikely, since 2008 grants basically disappeared, but it is well worth going to those two websites, putting your details in and see. You never know, you might get a couple of £1,000. It may be the foundation of something for you, but don't hold your breath waiting for it. Not going to sit and explain those. I've only got 10 minutes at maximum. I do want to try and squeeze in any questions anybody has, but there you go. There's some great resources. Insurance. I once heard a fabulous tale about insurance, which is why I always put this at the end of talks like this. Insurance. A man's walking along a beach. He sees a lamp on the ground. He rubs the lamp and a genie appears. And the genie says to him, Fill your pockets full of stones, and in the morning you will be equally happy and sad. So the man fills his pockets full of stones, and in the morning wakes up and they've turned to diamonds. He's equally happy and sad. He's happy that he filled his pockets because they're now diamonds, but he's sad he didn't fill his socks, his hat, his shoes, his belt, and everything else he could lay his hands on. Insurance is like this. It's a pain in the ass when it's weighing you down and you've got to carry it, but by God, you're happy when it's necessary. There's little in the way of required policies. Required policies are only employers' liability and third-party motor insurance. If you take on staff, you must have employers' liability. I would urge you to talk to an insurance broker. I do give one later. I'm not linked to her, than I personally use her for my business and have done for several years, and I've always found her bloody good. The stuff that you do want to give some consideration to, though: commercial liability, public liability, employers, product and professional indemnity. Now, product is probably not massively relevant to you guys, but public liability, employers liability, and professional indemnity certainly is. Employers, if you have staff, or if you are a limited company. If you are a limited company, you become an employee of that company, and you are going to have insurance. Public liability is if anybody comes into contact with you and results in a bodily loss because of entering onto a premises or using equipment that you have put onto it. Professional indemnity is absolute no-brainer for you guys. You are giving advice. If that advice goes in today's world, you will get sued. You want professional indemnity insurance. To give you an idea, for a business turning over under £100,000, you should be able to get all of that for under 500 quid a year. I'm not an insurance broker, but that's kind of seeing other people's accounts. Some other insurances, if you've got business interruption, director and officer liability, and key person protection. Business interruption, I think, is an important one. However, a number of us all got, including me, all got screwed over by the insurance companies with this one. I had a significant business interruption policy, which I believed kicked in when coronavirus kicked off. When my office was closed for a period of time, I went, oh, never mind, I can claim on the insurance policy. Except I couldn't, because they managed to weasel out of it, as is the way with all insurance companies. There is an ongoing law case for that. Well, in fact, the law case was won, but the insurance companies keep dragging their heels. Watch this space. Whether you have it or not, I still think you're probably better to have it than not. Director and officer liability. This is a policy you never, ever want to be able to claim on. This is if your company has gone bust and you are being sued. But again, like all insurance, it's not of any value until you need it. It doesn't, if you're a small business, it's not expensive. And certainly once you are established, or if you start taking out loans, I would start giving it thought to take on. Key person, I would certainly start looking at doing. Alternative to this being relevant life. If you have dependents, if you have children, and they are dependent children, whatever age you make that to be, let's work on the basis of 18. They're under 18 years old. You're going to want to ensure that you've got at least 20 times income available as an insurance policy to provide and look after them. It shouldn't be just enough to pay off the house. It should be a lot more than that. It's all very well paying off the house, but how do they then live if they're dependent? Again, some of those veers into financial services. That's not necessarily me, although I do have an in-house IFA if you do ever want to speak to anybody. But my recommended broker for this stuff is Elaine Barkley of Southwest Broking. Email, mobile on screen. Again, this will be available afterwards. Elaine has been brilliant for my business. She looks after lots of different types of businesses and lots of businesses, and I know she will look after you guys. Useful links. Everything I talk about here is available there as a book. The book's about 150 pages long. What expenses can I claim? I've written 2 guides to it. They're about 10 or 15 pages each. That's the cut down version. It really is the cut down version. again, depending on whether you're going to operate as a sole trader, partnership, LLP, you want that one. If you're going to operate as a limited company, you want that one. Do get them, do have a read. Told you you've got a lot to learn. And that is me. My name is Rob Newman. I am a partner at Carter, Collins and Meyer. I can be contacted that way. I'm happy to take any questions or help any way I can. If anybody does have anything now, please do stick them in the Q&A. Otherwise, I will hold on for a couple of minutes, but I think we're pretty much done. I'm going to try and stop sharing the screen at that point. A couple of people starting to drop out now, so I think we are probably done. If there is anything, let me know. Elaine doesn't do pension stuff. That's more of an IFA. Ian in my office does. If you put inquiries at uk-ccm.com, I'll forward it on to Ian. He can pick up with there. Yeah, there's a hell of a lot to digest there. There certainly is. There's masses and masses and masses of it. As I say, I could run this as a week's course. It could be certainly more than an hour. Do have a look on the YouTube channel. It will be up there. And as I say, please do download everything. I think that's it. If not, good night. Thank you for listening.